do, or at least what I will do, is just break down three codes or yeah, commands, you could call them, for using the bot. Now, the bot has a bunch of codes that you guys can go ahead and look into, but personally, there's only three that really could maybe help you define some trading decisions. And we'll show you how to read some of these things that are posted here, and then you guys can carry on with the rest of your night and see what you can do with it. But right off the bat, there's three charts that we're going to talk about. So one is going to be the algo flow versus the stock price. Now, the algo, this is not some like Wall Street algo or anything. This is just simply an algorithm that trades or tracks the option prices or the option trades that take place in the market. And the flow heat map, which is basically a open interest chart, basically just shaped in a graph with some sort of quadrants going on there using the strikes and expiration dates. Talk about that. And then the other one, which we will do, is this thing right here, which search up TopFlow. This is the TopFlow bullish versus bearish option trades that have been taken and held on specific stocks. So those are the three things we're going to talk about. Everything else, you guys can go ahead and watch their videos. These guys are pretty big, so they do have a YouTube channel. They also have a Discord server. You guys can definitely join them and see what it's all about and how you can maybe look up some of the other stuff that we don't talk about. But the three main ones that I do encourage everybody to use are going to be these three, which is going to be the top bullish versus bearish flow, the algo versus the stock, and then also the heat maps for specific stocks. Now, at the end of the day, just a disclaimer, nothing is 100% perfect. And at the end of the day, we're all just trying to find tools that can help us make better decisions or more informed decisions on some stocks. So we'll start off with the easiest one, which is actually the heat map. Now, simply, the heat map is just giving you an idea of what people are buying, whether it's calls or puts, which in this case is actually not labeled by green or red. Okay. All this is telling you is here's what people are piling into. You don't know if it's calls, you don't know if it's puts. All that you know is that there's a lot of people piling into a specific strike. And that basically gives you an idea. Now, the more people pile into something, usually the worse it gets. And then the less people um, pile into something, usually the less effect it has on the market. Now, there is nothing on here that says, there's no legend that says this is call or put. The only way that you can know whether it's calls or puts is simply by understanding that red and green are the net premium. So what this essentially means is you have a option. Say this is the strike that it's trading at. And if, let's say, 100 people buy calls, right? These 100 people, let's say buy puts actually, okay? Change it to 100 people buy puts. And then we'll say that 150 come and buy calls. Well, essentially, what the heat map is going to show you is it's going to show you a green, maybe not, bright green, maybe something like this where it's light green. And then it's going to show you plus 50, which in this case basically is just going to show you 50. And that's essentially what it is. It's going to go ahead and calculate the puts and the calls, and whoever has more, they will basically express that on the chart. And if there's more puts than calls, then, well, it's going to turn out to be negative. So if there's 100 calls, but also on that 100 calls, right below it on that same strike, right? The same strike, meaning that it's, let's say the 440 for this example, right? It's the same strike, the 440. There's 100 people who bought calls, and then there's also, let's say, negative 300 who bought puts. Essentially, what that's going to end you with is that negative 200 on the 440 strike. And then it stacks up. And once you start dealing with millions, these are the numbers that you start to get. And that's essentially what it all is. And it's actually pretty simple. So it's basically just the addition of the premiums for that same strike. How many people bought the 439 strike calls? how many people bought the 439 strike puts, and then they add them together based off the open interest. And whoever has more, well, they get to be shown on the chart right here. And if there isn't any, well, it will usually show zero, meaning nobody's really interested in that 420 strike. If maybe there's very little options for a specific stock, well, then usually if you do type out, usually the bot will reply that there's a lack of info for that specific stock. So you can see our good friend right here typed up the flow heat map for run. However, the bot says there's not enough data to express a full heat map, so therefore it's not going to show you anything. So what is this recommended to be used on? Usually indices, heavily liquid names as well. Those are probably the best things to use. Is this the best thing to use on a penny stock? Probably not, right? Because there's not many options being traded. So that's simply what this is. So to calculate it and to understand it, all you have to do is just some basic math to kind of get an idea. Below that, on the x-axis right here, you can kind of basically get an idea of the expiration dates these strikes are for. So on the first one, you have the 214. So the bottom expiration dates are basically the expiration date for that option. So here you have the 214 expiration, which is basically the expiration of today, the 216, the 218, the 225, and the 318. And these change. There's no set pattern for these, right? Yes, they do stay in order, but if there's not enough options for that specific expiration date, it will only express the ones with the most active options. So if you come and you say, well, how come there's no 218 expiration date for my stock? Is the bot scamming me? No, it's just there's not enough options for that expiration date. So just move on and try to find another stock. Um, but that's pretty much all there is. So, is this clear? Is everybody cool with this? You guys understand what the hell this is representing? If you guys do, then we can talk about how we can use it. But is everybody cool? Can everybody read this and know what's going on there? Give me a yes or no. Is the heat map dynamic or is it the daily data? What is the refresh rate? I'm not 100% sure what the refresh rate is, but the guy told me that it is usually every 5 minute to 1 hour. But again, I'm going to need you guys to pay attention. This is not a scalping thing, okay? This is something to use for broad scale investments or trades. So it's not something you want to use on the 1 minute chart to justify something, okay? These are bigger macro trades when you're using this heat map. So this is where it's going to get pretty specific when it comes to using this. Number one, these generate what we call as walls. So if you know what a wall is, you guys remember that little thing Trump tried to build? Yeah, that's a wall. And these essentially do the same thing except in the options world. And in the options world, what these walls do is they create imaginary levels of support and resistance or supply and demand, which is essentially made to protect the market maker from specific things that occur, or maybe plays or hedges that he wants to protect himself from basically losing too much money. So, to read this simply, is we can go ahead and choose a place where there's a lot of money. So you can see right here, there's a lot of money on 8 point, well, there on the 325 strike for the QQQ. Now, there's an issue. While there's a lot of money here, the problem is the expiration date. So essentially, what we actually like to say is the further the expiration, the less power it yields to the current price. So wherever the stock price is right here, we're basically 5 months away or 4 months away. This option right here yields very, very little power to move the stock here. Why? Because the market maker is not in trouble yet. Because the market maker is only in trouble once the expiration date gets close. So, therefore, what we like to say is we say this is basically something you don't want to pay too much attention on because there's really not much that they can do. However, when do you want to use these very, very far expiration dates? Usually when corrections happen. So in a situation right now where the markets have corrected 10, 15, 20%, then it's actually pretty smart to start to use these further expirations so you can kind of get an idea of like, okay, where's the market trying to go? Because it probably has an objective. There's probably some dude some corporation or hedge fund, just relaxing in some random option strike, and they're basically really, really safe, but the market maker wants to go for their neck. That's when you want to use this. But in the short term, probably not. And by short term, I mean 3, 4, 5, 6, 7, 8 weeks out, not anything that important. So what this essentially means is we're actually only paying attention to for maybe the next 2 to 3 weeks only. We don't want to go too far out, especially as traders. We're not investors that are trying to hold something for 10 years. We want to pay attention for the next 2 to 3 weeks maximum. So the maximum is going to be around here. And you can also consider the next monthly option as well, dependent on if it's a quad witching date as well. If it's a quad witching date, then it's actually really important. In this case, 318 is a quad witching date, so we also do want to consider that. So right off the bat, we're just going to eliminate this and say, okay, this is too far. We don't care too much for it. Okay. Now we're going to go ahead and actually find a place where there's a lot of calls and there's a lot of puts. Well, essentially here you can see there's zero right here. There's 142K there. There's 88K there. There's 58K here, and there's 860K there. So we know this is actually a pretty specific strike. So this is going to be something that kind of catches your eye because, well, this is basically double all of these combined. So what you do is you go on your chart and you say, okay, I'm going to pull up TradingView, and then you search up QQQ, and you go ahead and you basically just draw a line there at 346, which is right around here. Just draw a line, that's all. Then you go back on the chart and you try to look for some other strikes. Well, we can see there's two that stand out on the 2/18th expiration, which is this Friday. Now, these change a lot throughout the day, throughout the week, they actually change. So you want to also monitor this closely. But usually, you can see right here, this one stands out and this one stands out. So the 350 strike and then the 340 strike. What do these do? Well, these create barriers. They create walls for the stock. Meaning, if it's a call and somebody bought calls for the market, which are basically in this case labeled in green, then what you expect is as the stock goes up and it starts to reach that 350 level or 340 or whatever. In this case, this one was calls 863K for the 346. What we expect is something like this, that if the market gets to that level, I'm going to delete this, go down to a deeper time frame. All it simply means is this right here, that if this is 346, every time the market gets to that level, we expect that there should be a barrier. So since it's calls, we usually say that this is going to be a barrier to the upside. So the market is just relaxing, it's going nowhere. Every time it comes near that level, we expect it to hit a wall or a ceiling or a roof and get rejected off of it. And the whole objective is, can the market close below that price? Now, why is it key that it closes below that price? Well, if you know anything about options, that is considered to be an out of the money contract. And if you know anything about options, again, anything that expires out of the money is considered to be worthless. So if your option is right here and the the market closes on the date of your expiration and you're below, anything above this green line goes to zero. Doesn't matter how far or how close you are, everything goes to zero. And that's exactly what the market maker wants, is he wants all of these options that somebody bought for the 346 strike, he wants them to expire worthless so he doesn't have to pay them out. Why? Because, well, market makers sell options, they don't buy them. Me and you, well, we think we crack the market's codes and we think we can just buy deep out of the money options and somehow hit a home run and make 1,000. So essentially, if I go ahead and actually look at QQQ, you can see today, well, there was an expiration date up for the Monday session for QQQs. And if we scroll, you can see everything above that price for the QQQ essentially went to 0 or 2 cents. And that's because, well, the market kind of pushed a bit. But the market closed around that 347. And you can see the 350 calls, all this volume, 76,000, all of these guys went to zero. This also went to zero. Anybody below that price basically made money or has some sort of value in it. So they're kind of saved into here. But the whole objective of the market maker is look where the wall is and try to make sure that the stock does not close above it. It has to go below it. Now, sometimes in many cases, they'll actually do a little fake out where it goes above it, traps more people, and then comes back. But a good chunk of the time, if it's a big enough wall, you will see tremendous energy rejected. It will be really, really bad, and you'll never know what comes out, but something negative will always come out to basically block it. And the same essentially happens for puts. So for puts in this case, they're actually going to be labeled in red, meaning that there are more people buying 350 puts than there are people buying the 350 calls. And just like how the calls create a ceiling or a roof for the stock, right? The puts actually create a floor for the stock, a bottom per se. So if we go ahead and actually look right here, we can see that the 350 strike was something that a lot of people were buying. Now, if the stock, okay, if the stock was actually above the 350 strike. Okay, so let's say the market essentially right here, look at this. This is where the 350 strike is. It's right around here. If coming into that expiration, the stock is below it, then it's in the market's maker's best interest to take it above. He needs it to close above that 350. Why? Because anything that closes below 350 and is a put goes to zero. Okay, all of those go to zero because they expire out of the money. And anything that closes above, well, that closes with some value, but he doesn't care because majority of people bought the 350 puts. So as long as he can close the stock above that 350, he's good. And let's say the stock is actually above here. What if the stock is at 354, but there's a lot of people who bought 350 puts? So the first time we were coming from the bottom, and all of these are puts. 350 has a bunch of puts. If we are coming from the bottom, the market maker wants to close it above. If we are coming from the top, the market maker wants to use that as support and bounce off of it. Okay? So, one more time. There's a bunch of puts on the 350 strike. If you're coming from below it, meaning people bought in the money contracts thinking they're safe, the market maker will try to go above it and close above it. So therefore, this actually becomes support. It never becomes resistance. Very rarely does it become resistance, right? Usually it will bounce above it and it'll come back and it'll test as support and it'll try to close above it. And the same thing, if it's coming down to it, then it will also bounce off of it as well, using it as support. And the same thing happens for the calls. So if you look at the calls right here, you can see there's 1.49 million open interest in total for the calls of the 340. So if I go ahead and actually draw a 340 strike line, we'll go ahead and draw 340 strike right here. That shows you that there's a lot of calls at that 340. Well, the stock right now is kind of way above it. Well, it's in the market maker's best interest to take the stock below that price, right? He wants it below that 340 because he wants all those calls to expire worthless. If he holds it and it stays all the way up there, well, he's going to have to pay out all those options that he sold, which could be negative thousands of percent, not negative 100% or negative 10, 10,000%. It could be in the hundreds of thousands that these things could really go into, especially if they're like 1 cent contracts that get really, really ugly. So the market maker is going to try to go below. Now, people will say, well, okay, if the market maker is such a bastard like that, well, how do they even manage to do all this stuff? Clearly, they can't just manipulate every day. Well, they can. That's the sad thing. But what you have to understand is they don't always have to drag it down. So, for example, if the 340 strikes has 1.5 million, right, and the 350 puts right here, as we drew, if these 350 puts we're going to label as red, just to give you a better idea. These 350 puts have 2.6 million. Well, the market maker is just going to choose the one that has more money involved. So if there's a lot of puts more than there are calls, then the market maker is actually going to try to close the stock above 350 instead of trying to drag it down all the way here. Why? Because, well, he can make more money over here. So at the end of the day, the market maker lost 1.5 million, but he also gained 2.6, which basically leaves him with a net gain at the end of the day of maybe 0.11, basically, right? He basically gets to make 1.1 mil off the gains. So essentially, the market maker will go for number one, the most money. He wants to go for the ones with a lot of money. And then number two, he wants to go for the one that's easiest to do. So basically, which one is actually easier to perform based off this situation? Is it easier for the market maker to make some news and some BS to, hype up the market and drag it above 350, which is $2 away? Or is it easier for him to drag it all the way down here? Clear that it's much easier to take it above because you're $2 away versus the distance between the here to here, which is $10. So the market maker will always use those two rules: the one with the more money involved in it, and then also the one that's easier to perform. And that's usually how it works. Now, of course, there's actually a little bit more that goes into it because, well, there's also other options that are involved. Now, if you're trading individual stocks, unless there's a lot of money involved, usually your stock will probably be the one that gets saved or the one that gets slaughtered to kind of compensate. Because if the market maker is in a situation where he's like, I can't take it above here because it's way too hard. Because if I take it above here, there's someone with 10 million open interest on Apple. And if I drag the S&P or the QQQ above 350, that's going to also drag Apple above the strike price, which means I have to pay these out, and I don't have anything to compensate for it. So I'm going to have to keep it here, take the L for this one, and take the L for this one so that I can basically clap Apple and make money off of there. But in other cases, maybe the market maker says, okay, well, there's 10 million on Apple, but there's also negative 20 million on Tesla. That's where it starts to get very complicated, and people need to pay attention to that. And this is where the TopFlow heat map comes in right after. But as far as this, is everybody clear on it, how it works? Do you guys have an idea of how you could use this now before we get on to the other thing? We get a yes, just to make sure. All right. Okay. Now here's the other thing right here. So this is the TopFlow. So what you do is you look at the SPY and you say, well, okay, the QQQ, whichever. These are ETF. These are indices which basically hold a few hundred stocks in them. What this means is, okay, if you look and see that the Nasdaq is very, very bearish, a lot of people are buying puts. Well, what do you expect? You expect that the Nasdaq should probably be bullish. Well, you have to go ahead and see on the TopFlow what exactly are people betting on or against. So if you see a lot of people are getting puts on Tesla, a lot of people are getting puts on Apple, a lot of people are getting puts on Microsoft. Perfect. That's the good bait because all of them are bearish. The market maker has no interest in going against it, meaning that he could just clap everybody by just dragging the NASDAQ higher. So, what is he more likely to do? Well, this is where you could say macro news comes and gets involved, where somebody from the Fed or some news off CNBC, some war, some dude, dies or whatever happens. That's where they can just go ahead and do broad market manipulation. Broad market manipulation is basically anything that causes the Nasdaq, the Dow, and or the S&P, which is the general market, to move in one direction, which then basically involves the movement of every one of their holdings in that direction. If we're talking about specific manipulation, well, it has to be that that stock is being specifically targeted, which in some situations happens, like the NVIDIA gamma squeeze that occurred. That was specific manipulation on NVIDIA. Sometimes it happens in Tesla, where there's specific people coming for Tesla's neck. Sometimes it happens in Apple, sometimes in Facebook, sometimes in Disney, sometimes in AMD, sometimes in Microsoft, whatever it is. Those are specific manipulation. So what you only have to understand is, if the entire market is bearish and Apple is also bearish and Microsoft is also bearish, do you want to buy puts or do you want to buy calls? You want to buy calls because everything is perfectly in correlation. If there's a divergence where the markets are bearish and then Apple and Microsoft are bullish, but there's more money involved in Apple and Microsoft than there is in the QQQ, well, more than likely the market will be bearish because there's more money involved in the bigger names. If there's more market in the there's more money involved in the ETFs, let's say there's 2 million on QQQ, but there's like 600K on Apple, and there's also like 300K on Microsoft. Well, then the market sentiment being bullish will basically take the L for these two just so they can compensate for this one because this one is the bigger trade. So that's just kind of an idea. And of course, this is going to take you guys a little bit of practice, and we'll have to do more lessons on them over time to keep you reminded. But that's kind of just the gist idea of what this is. So knowing that, now you go ahead and you look at the top bullish flow. But before we do that, to search up the heat map, all you have to do is simply search up TR like this, and then flow heat with no spaces map, and then you can search up the ticker right after. So in this case, I just say Apple, and you search that, and then give the bot a second. Sometimes it lags, and it'll reply, and it'll give you all of this. And again, to read this, the y-axis, which is right here, will give you all the strike prices, and then the x-axis on the bottom will give you all the expiration dates. And if the expiration date is not there, well, more than likely there's not a lot of trades open on that, so therefore the bot will not express it. And then if the bot replies with a negative, for example, let's say I search up something like, let's just say CRISPR, right? CRISPR is a low liquid name. Nobody really trades it. You can see the bot did not show much data for it. It only showed me that there's a bunch of puts for the 7/15 expiration. So if there's not enough data for it, it'll probably just show you nothing, or it'll reply with a negative code saying that there's nothing there. In which you could do two things. One, if you think that stock is heavily active, it's just there's nothing there, you can always check back another time. But if you think that there's actually a problem, then I guess you can ask. But yeah, that's pretty much that. Now, the second thing is basically the top bullish versus bearish. Now, you want to go ahead and search up TR top flow. So you search up TR and then top flow right after, and then we'll show you this. Now, here's the key with this thing. This thing works great on Friday. Okay? On Friday. I was about to butcher the thing. Why does it work well on Friday? Well, that's when the expirations happen, right? When the expirations expire, that's usually the last day in which the market maker has a chance to save himself. So what this means is all these guys right here are loading up on calls, and all these guys here are loading up on puts. Now, you want to do your research the night before, which is basically going to be the Thursday session. So, the Thursday night, when you guys are here on the watch list, pull up this thing and get an idea of like, okay, what do we got? Seems like a bunch of people are clearly bullish on Google. Some people bullish on the two indices. Okay, so we got a FANG name. Actually, got two FANGs, and then we got the two ETFs, so that they're kind of holding strong together as a team. And you got a bunch of nothing, right? It's just Facebook, Disney, Square. There's not much money being placed. The majority of the money is being placed on the bears. So the bears are basically Tesla, DWAC, Live Nation, SPGI, EWZ, which is a Brazilian ETF, or United Kingdom, I forget which one. And then you got UPRO, which is basically the triple leverage for the S&P 500. The VU, which again is just the Vanguard version of the Standard & Poor 500. TLT, this is a bond treasury note. That one, basically an inverse correlation to the SPY. And then you got gold, the safe haven, against TLT as well. And then you got OIH, which is the ETF for the oil stocks or energy. Doesn't seem like there's much correlation. However, one thing we do notice is that there are triple leverages against the UPRO. There's bets against the VU, and there's also bets against TLT and then GLD. So the way I like to do is okay, well, the VOO is essentially just a SPY. So this is gone and this is gone. UPRO is literally just a SPY on leverage. So the fact that there's people betting on 3x leverage against the SPY, that means that there's actually a bit more bears than there are bulls in the market, which actually might signify that maybe there's a bullish market. So essentially, the way you want to analyze this is you want to be the opposite of the flow. Okay, so you're essentially betting against big money. And majority of the time, usually you don't want to do that. But in the case right here, when you're betting against big money, you're actually siding with the market maker. And the market maker is the daddy of all big money, essentially. So what we're doing is we're finding all the ones that are bearish and all the ones that are bullish, and we want to do the exact opposite. People are bullish on Google, we're bearish on Google. People are bearish on Tesla, we're bullish on Tesla. When are we bullish? On the Friday. Okay, on the Friday. Now, do we close our eyes and blindly go buy them? Probably not, right? You do want to do a little bit of technical, see where you're at, find good opportunities to buy Tesla at a dip, find good opportunities to short Google on a rip, right? Try to find those opportunities. But the essential idea is that you want to bet against these to side with the market maker under the assumption that it makes sense to why this might happen. So essentially, what I will do is let's say, okay, well, this seems like a lot of people are bullish on Google. What I like to do is I'll go ahead and I'll just search up the TR flow heat map to get an idea of what the indices are saying. If I search up this for the SPY and the QQQ, well, we can get an idea that, okay, for tomorrow or for the expiration for the same thing as Google, it seems like the markets are very, very bullish, right? There's $12 million in calls for the SPY for that 1218, a lot of bullish people, and then for the QQQ, a little bit of bears, not too much. So it makes sense that if this was tonight, right? Assuming this is tonight and we're basically here, right? Let's say we've already done these, we're done. We're tomorrow is going to be the 218 expiration. I would basically say, okay, market seems really, really bullish on the calls. A lot of people bought Google calls. I would open up and look for violence and try to short Google. Why? Because there's a high chance that if the market collapses, Google will be one of those big leaders to the downside. It's not going to be short Apple, short Microsoft. No, it's short Google because Google is going to be the leader to the downside, basically. And the same thing could happen against us. Let's say tomorrow is the expiration, and instead we're going to use the QQQ. Well, the QQQ says, okay, well, there's a little bit of bears right here, not many bulls until 340. So what we essentially say, okay, well, there's a lot of bears on QQQ. There's also a lot of bears on Tesla. Well, I'm going to use that to my advantage and try to buy the dip on Tesla and get calls to play the upside because more than likely Tesla is going to get clapped. And if you go ahead and you pull up the flow heat map for Tesla just to get an idea, you can go ahead and click that. This is Tesla. Minute, well, you can see, okay, well, Tesla is saying that there's a lot of puts there, but there's actually a bunch of calls, sadly. I don't know what the hell the bot is doing. Maybe there's different calls for specific strikes. But essentially, right here, you can see if this was tomorrow, right? If this was to basically Thursday night and we come and we look, there's calls. You don't want to be long Tesla, right? In this case, you would want to short it into that expiration because more likely stock is going to crash, not go back up because there's a lot of calls there. And then also, where do you want to short? Well, you go ahead and you look for the biggest order. The biggest orders are at that 850. So we expect that if Tesla is below 850 and it goes to that strike, more likely, let's say 850 is right around here. This is the line. Well, it's going to go there. It's going to grind. It's going to go crazy. And then it's going to get there and completely collapse out of it. Or in some cases, we'll actually get there and it'll hug it. It'll just stay there. And then the next Monday, after those expired worthless, then it'll rip and it'll go for the breakout, in which a lot of people basically already lost their money and then it goes up. So basically, it's going to be a wall that holds the stock below it until those expire. And then once those expire, well, then you can basically go up. And there's also something that's pretty important for you flow traders that if you see some dude who's heavily bullish, for example, basically on the flow right here, and you see him post, well, okay, some dude is really, really bullish and he's put 600K on the 80 strike for Marvel and this expires on 218. Do you want to buy 218 expiration? Probably not. Why? Because, well, this idiot decides to keep buying more and more of the 880. Essentially, what that's going to do is create a roof since it's out of the money. So, therefore, the stock will go to it and it'll just stay there. And then once this expires, which is basically the week after, then the stock might break out. And you're like, oh my, I should have bought further expiration. Just buy further expiration from the start. Do not let these guys create walls that you end up getting baited into, because essentially what these guys do is they tend to exercise their contracts or basically just take the L and buy back in again. So make sure you kind of do look out for that. But again, the top flow is more of a Thursday analysis thing, looking to play Friday, and you could honestly hit some big winners. I mean, last week we hit, at least I did. I don't know about everybody else, but we hit almost 5,000% on a firm because of this. Now, was I there in the server lurking and stuff? No, but I knew that there was a lot of calls on a firm, and once we got the opportunity to short it, well, it made sense that okay, well, that was a good thing. And then also, our good friend in the server also made a post here to give you an idea as well. You can see this was from last week. So if you look at this, you can see what were a lot of people bullish on. A lot of people were bullish on Amazon. A lot of people were bullish on DWAC. A lot of people were bullish on Twitter, TFLT, Facebook, Rivian, GM, Apple, Google. So many calls were being placed. One of the biggest ones was Amazon for that 3,300 strike. We talked about that one. So therefore, kind of just set a basic list. You short Apple, short Twitter, short Rivian, short Amazon. Now, did they work out right away? No. Actually went up and they stayed there, and then randomly they end up collapsing. So you want to kind of have faith. Do you want to YOLO your entire account into it? Probably not. But try to play it in a smart way. You don't have to get same days. You can if you can afford to basically take the risk. And afford to take the risk doesn't mean you have money to burn. Forward means that you've been doing good the entire week. You've made a little bit of money. You're in a position to where you can afford to speculate a bit more aggressively. If you've been losing the entire week, this is not a let's go all in and pray for the best, right? Make sure you're actually prepared for this. And the same thing you could see for here. AMD and IWM and the SPY, essentially the market makers saw that there's more of a benefit to go, to clap the calls than there was to clap the puts. Maybe because maybe the indices were not so bearish, even though they shows that there was a lot of bears. Maybe things switched because again, the flow for the SPY tends to switch very, very quickly since they do offer same day expirations. So there was more of a benefit to clap to people with the calls. There was also a lot of calls on a firm and some of these other guys as well. Didn't show up here, but we knew where their strikes were placed because we saw them on the flow. So that's pretty much all there is to this. So look at this on the Thursday, get an idea, and see if the market is in your direction. And maybe the markets are really, really bearish, and the stocks that you want to go long are also very bearish. More than likely, if the flow heat map shows that your options, uh, have a lot of bears that expire today or tomorrow, then it's probably a good idea to bet against them and go and try to maybe go long. And as far as the heat map, somebody would ask and say, well, okay, if there's a bunch of calls and puts on both sides, what do you do? Well, essentially, what that does is it creates the maximum pain level, which what it basically means is there's a wall here and there's a wall here. So it's in the market's maker's best interest to just try to make the stock stay within that range. Not too close to the top, not too close to the bottom. They want to stay within that range. You can always use bar charts or anything like that to find where those specific strikes are. Or you can actually search up TROI, which just stands for open interest, the ticker, and then the expiration. So in this case, let's say today's expiration, 2/14, and then 2022, and it'll show you where those strikes are. So essentially, if you look right here, well, you can see there was a bunch of puts on that 437, and there was a bunch of calls on that 480, 475. And there was puts here, there was puts here. It made sense to why the market rallied near the end of the day because the only big call was all the way at the 50, 60 level. So therefore, the market maker tries to expire them right in between here. Why? Because well, all the puts are here and all the calls are here. He's going to try to chill right between there if there's a lot of money involved. If there isn't, then he'll probably wreck all of them. But since there's always a lot of money involved, that's where they try to expire, and that's where the markets ended up trying to close. Now, essentially, they closed right around here in between. So this put basically survived. And again, the market maker is not trying to kill everyone. Okay, he's just trying to stay away from major, major danger. This is major danger. This is major danger. This is major danger. This is major danger. Same as this. this one. You can take L's there. It's okay because, well, you can always compensate them for other stocks as well. So they're just basically trying to make a few bucks from balancing the markets whenever they get extended or go crazy. Um, and that's pretty much that. Those are the two tools. Use this on Thursday, really useful thing. Use the heat map every Monday, Wednesday, and Friday. It's a really nice thing to see because it gives you the same day expirations. You can kind of get an idea of what's up in the market. Not the best to use on Tuesdays and Thursdays because, well, the S&P does not have same day expiration dates for those dates. And then for other stocks, you always want to look at them on the Thursday, or you could look at them just in a general broad view. Seems like, okay, well, here's where a lot of support is, and here's where a lot of calls or puts are. So essentially, what I'm expecting is that when we get to 445, is that maybe even if it happens tomorrow, the market will go to 445, and as long as this stays valid, it'll probably get rejected off of it. So it would be a good idea to short off that. Okay. But that's pretty much that. Are those two things clear? Does anybody have any questions? Now, Raider did already do a lesson on that, so we're not going to go too crazy on it. But essentially, what you're doing is when you search up TR AlgoFlow, you have a few options. You just search up TR AlgoFlow, and then you search up the stock that you want, and then you can search up 1 to 6, or you can just keep it without a number. Now, what these do is they just show you bigger time frames. Okay, they just essentially show you bigger time frames. And if you have the subscription for their thing, which I'm not, I think I have a still have mine. Aw, I thought I had one. I never canceled it. Should be active. Ooh, it is active. Yeah. So if you search up on here, I think this is the place, or is it this one? Oh, there you go. So this is essentially what it looks like. You basically get to choose the dates that you want. And if you search up 6, it is basically going to show you the 30-minute candle, and 4 or 5 will show you different types of candles. If you keep it on 1, it'll show you the 1 minute. Now, you're not going to search up 30. So if you do it right here, you search up, let's say 4, it's going to show you the past 4 days of data. And if you do it for, let's say, TR, Algo Flow 5. 5, I think, is the max. Then search up a ticker. If you 5 is the max, so it gives you up to 5 days of data. So you can see this one you from 209, right, which is basically the Wednesday of last week, 211, which was the Friday of last week, and then 214, which is today. So 3 days. If you search up 4, it gives you 3 days of access. Search up 5, it seems like it gives you 4 days of access. So it just gives you 4 days back. Now, if you have the website, it seems like you can go really, really far back. So I think it's a bit laggy from what I heard. Yeah. So if you have this one, it lets you go way, way back, but not really needed. But essentially, what you're looking for in charts like these is, well, the yellow line is indicating the stock price, which is this thing right here, and then also the algo flow, which again are basically just option trades made by algorithms or just regular professional traders, shown usually by the pink line, which ends up being green if it goes above the 0 level. Now, on the x-axis, this is on the y-axis, that's the stock price, and on the x-axis, you will get the time frame that you're looking at for that stock. How do you read this? You're looking for two things. Essentially, you want a divergence, basically means that the stock goes one way and that the algorithm goes the other way. That's a divergence. They're just going opposite directions. Or you're looking for spikes, or basically leading spikes. You don't want them to be lagging spikes. So what this means is, let's say the stock is going down, like it is right here. A leading spike will basically have the algorithm going down with it, and then randomly spike really, really high and stay there before the stock does anything. If anything, the stock can keep going down. Those are exactly what we're looking for. Major leading spikes or divergences that occur between the stock and the algo. So what is that going to look like? Well, you can see here the algorithms were all selling while the stock was going up. that's a divergence that maybe the market is going to tank. The stock tanked, but the algorithms didn't do anything. Kind of stayed there. There's no indication there. The algorithms are selling again while the stock is going up. That's another divergence. Then the algorithms are selling with the stock. Nothing here. So the only important parts have been this section where the divergence occurred, and then this section where the divergence occurred. Outside of that, when they're both downtrending or they're both uptrending at the same time, well, there's really not much there for us to use. That's not of any of our interest. You can see here the market started to really tank. The algos also tanked. The market slowly started to actually consolidate, but the algorithm started to buy. So what is that? Well, that's probably an indication that maybe a nice reversal might actually happen on the SPY. But what do we want to see? Well, maybe a spike, right? A spike would really, really help us. Or maybe the stock price to stay down here while the divergence gets bigger. That usually gives you a better indication. Um, that's pretty much all there is to this. And you can go ahead and use it as a leading indicator. You could also day trade off of this, even though I would recommend maybe being very careful with that. If you want to day trade, you want to look at very, very small time frames, well, you can kind of get an idea. Well, here the market was tanking and the algos were all buying. That's maybe an indication that there's a bottom and well ended up reversing as the algos also continued to buy. The algorithms here bought and bought and bought, and then the market started coming down, and they held. They didn't sell anything. But there was this spike right here, right in the middle down here. That's something you want to pay attention to. Do you buy right away? Probably not. But that's something you would pay attention to and consider. And then you play the divergences back and forth. Sometimes they're really, really easy. Sometimes they're not so easy. So you have to kind of, give yourself a little bit of discipline to tell you is like, okay, well, this is very clear that it's, going against something. And this is not so clear. It's a bit fishy. It doesn't really give me the confidence to say okay it has to drop or it has to do something because the whole point of this is can you gather enough information to increase conviction in your trades. And if there's something that's not so clear, maybe this one right here is very clear that if we can just go maybe a bit higher while the stock stays here, I would say that's an A plus setup versus maybe something like here, right? The one I was just looking at, where yes, there was a spike, but the spike did nothing. All it did is go up and then it came right back down. Is there enough conviction in something like this? Probably not. Why? Because, well, the market tanked, the algorithms are holding, kind of looks like a divergence, doesn't really 50-50. Well, you don't have to roll the dice on something like that unless your risk to reward forces you to do that. But that's just the main thing you want to do when you're looking at this. Some people are saying this doesn't work really well with every stock. I would just say if you're going to do it on anything outside of the S&P, try to stick to maybe 2, 3, or 4, on the time frame to kind of get a macro image, and then also combine it with the flow. Maybe you'll see something very special. So you can see here on Apple, we had a little bit of a spike on Apple on '09, ended up downtrending, didn't do so well. Doesn't seem like it works too good on very small time frames, but again, these could also be market conditions due to extreme volatility. It seems like a lot of people are losing money in general, so maybe not the best strategy to apply on certain stocks at the moment, but doesn't mean that you should ignore them. I would definitely say do your research and try to see. But I know these work really, really well on bigger time frames. But specifically, if you want to day trade and make the best out of them, it works really good on the SPY from what I've seen, and it also works really good on the QQQs. But that is pretty much it. I got a date to get going on to, but